Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Now, anything can happen at any point in time. And you'll see a lot of activity. Those are the trades that I'm proud of. Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest and author of the Options Playbook. All right, we're in September, and September has not disappointed us in the fact that we have a lot of volatility. Year in and year out, for some reason, September seems to be a very volatile month in the marketplace. Mentioned it many times here on the Stock Play of the Day that September has historically been the worst performing month on the calendar year in and year out. And this time around, based off of what we saw last week with CPI, geopolitical concerns, energy crisis, all this stuff going on, and we had a real rough week last week. If I look at my VIX watch list, which I'm showing you here right now, it's just amazing the bounce off the 200-day moving average when we look at the S&P 500 index. To start with, we're down just over 0.5%. NASDAQ is down just a smidge. Russell 2000 is also down about 1%. We have oil coming off. The USO is down over 2%. One of the only things that is not going down is the yield on the 10-year Treasury and also on the 2-year Treasury. It almost hit 4% today on the 2-year. If I look at the TNX, which is the 10-year right now, we're seeing it at 3.569%, so 3.5% on the 10-year. People are getting to the point where they're thinking, well, I don't want to deal with this marketplace. Maybe I should bail and just, run to safety and buy some Treasury bills, especially if you're looking at what you can get on the 10-year relative to the returns in the marketplace. Now, this week, and I'm going to highlight this, I actually filled in for Lindsay Bell this week on the Ally Invest Weekly Viewpoint. And if you go to my Twitter, my handle is very simple. It's at Brian Overby. You can see that we talked a lot. We went into detail on our Friday Weekly Viewpoint, talked a lot about the energy stocks and the markets in general, and maybe bottom fishing, and just the fact that September and October are volatile. Longer term horizons are easy to kind of understand what to do. Long term, most markets, after they're down over 20%, will usually make a full comeback in 2 to 3 years. Now, that's a long time frame for that, but they're usually positive and doing pretty well historically after 2 years after we hit a 20% downturn in the marketplace. Now, history is never a predictor of what's going to happen in the future, but that's one of the data points that we can look at to try to figure out what's going on in this marketplace. Now, I think I mentioned this on a Stock Play of the Day, but this 200-day moving average was going to be a point of resistance on the upside. We were finally getting our ducks in a row when the market was really strong and a good solid market. You have the 20-day on the chart below the 50-day and below the 200-day. That means that you have your ducks in a row. a sign of a very strong market. We really were trying to get up above, September was coming on, and we were trying to get above that 200-day moving average, but we literally bounced right off of it. It's been ugly ever since. This was actually a golden cross when the 20-day crosses over the 50-day moving average, and now we've had the death cross. And when that happens, once again, I don't put a lot of emphasis on those. Those are very dramatic terms for the moving averages and what will happen with it. I think it matters a lot more if it happens over like a 50-day crossing over a 200-day moving average. But nonetheless, we've had that happen, and ever since we've had the golden cross, the market was strong. Now we see the death cross, and the market is looking fairly ugly. We don't know where the stopping point might be on the downside, so I'm going to kind of do a rinse and repeat this week in that. Last week we looked at the Qs and we got bearish on the Qs, mainly because of what had happened with CPI. The numbers were a little rough, and to be blunt, it's very hard to find a stock to try to be bullish on in the marketplace. So it's easier just to be bearish. And so quite simply, we got bearish on the Qs. CPI was higher than expected. It's kind of settling in a little bit, and the inflation numbers are, but still the direction means a lot more than I think the difference as compared to what was expected relative to what happened. Inflation was expected to go down, but it did go up in the month of August. And because of the direction of inflation, everybody was saying that we had peaked. That meant a lot to the markets. And also, we even saw the Fed funds rate, the Fed Watch tool on the CME, actually spiked to a potential 1% hike this time around this week in the Fed funds rate. So there was about a 30% chance after the CPI number came out. Now that has dropped down to, I think yesterday I looked at it and it was around 18%. So a lot of people are expecting them to stay the course with the 3/4 of a point hike this Wednesday, but obviously everybody's going to be waiting with bated breath at 2 o'clock on Wednesday when the Fed comes out and starts chatting about their meeting overall. Okay, so SPX, VIX up around 26%. VIX still, I don't even know what to say about that. We just can't get that capitulation moment. Potential, we're going into October. There's a lot of volatility in October. So I don't think that we're quite out of the weeds yet. Would like to actually just see a big, strong down move in the market just to flush everybody out, see the VIX spike up to around that 40% level, maybe set a new recent high, and that would just give you a little bit of more oddly confidence in the marketplace. And hopefully then we can start rooting for a Santa Claus rally going into December. And that would be an ideal scenario as far as the overall market is concerned, in my mind. Now, obviously going down is never a good thing in the marketplace, but we've just never had that flushing out moment of all the sellers in the marketplace. So, ideally we'd just like the markets to come back, but it's really hard without that moment, it's really hard to say, okay, now is when I want to allocate some capital to the marketplace. In the weekly viewpoint, we talked about high-paying dividend stocks in the energy space and talked a lot about what's going on in the geopolitical concerns over in Europe. Definitely some good news that came out last week about their stockpiles of energy, things that they can use to heat their houses with. So that actually did help, or it did actually hurt a little bit on the energy stocks, only because they're kind of thinking that demand may be waning. But with that said, a lot of there's just one black swan or unknown event could really drive energy prices skyrocketing. Last week, they still continue to have a lot of concern about this nuclear power plant that is in the hands of Russia and Ukraine, and they're battling over it. There's still some artillery and some shelling that has happened around that, and that would just be an absolutely horrible event if that ever happened. All right. So continuing the theme of being bearish in the NASDAQ, we're going to take it one step further this week. Last week we looked at the QQQs, so let me pull up the option chains on the QQQs. 1 second here, and we'll look at that trade. All right, so there we have it. The last trade in the Qs was 290 down 290.56, and last week we were looking at 297.65. That's from my screenshot from last week in the QQQs. We're down just a fraction today, but the trade overall, we wanted the market to get down below 295. So we bought the September 30th expiration, which is now 10 days away. We wanted the market to go below 295, and it has. So this is what our trade was. We bought the 301 strike put with that September 30th expiration. I'm going to highlight that these are puts on the right-hand side of the Ally Invest option chains. And we sold the 295 strike put. We did this for around 280. We're trying to get the midpoint, but obviously in the Qs, we have extremely liquid markets. I would think we would get somewhere close to that. Never guarantee a midpoint fill, and I never enter a spread at market. Always going to try to work that order. Don't forget you got to add in commissions. Since this is a long put spread, the net debit that we paid for that trade is our maximum risk. A long put spread is very similar to just buying a long put, just buying a put outright. And in that the net debit that you pay for it is the maximum risk of that trade. So $280 was our risk. Our maximum upside was the width between the strikes, which is 6 points minus 280. Maximum upside would be $3.20. Now, we talked a lot about the timing of this trade. The fact that we picked that September 30th expiration. And that's kind of hurting us in the sense that, and I'm going to run over to the option chains now, in the sense that we've been correct on our forecast, but kind of correct too soon. We still have 10 days remaining. So in order for us to make the maximum of this trade, we need some time decay to happen in the 295 strike put. Not to mention the fact the VIX index or volatility in general has increased because we've had some down markets. And there's two things that can make this trade more profitable. We get some, with the stocks or with the QQQ staying where it's at, the ETF, the two things that can happen is we need time decay to happen on our short 295 put, or implied volatility to come in and go down. That's another way that we would reduce premium, and we have to buy that back to close out this position. So here's our trade. We see that even with 10 days remaining, the fact that the QQQ is a $290 stock and a fairly expensive ETF, and the fact that implied volatilities are up, 35% is what this option's trading for, means that this option contract is still $9. In order for us to max out on this trade, we need the time premium to go away. So in this instance, we have $4.77 worth of time premium. Now, I'm just doing a quick little trick in that if we look at the 295 strike, the call would be out of the money on the call side, and usually the call is going to be very similar to the amount of time premium it's going to trade for that you'd find in your 295 put. So the fact that we still have $5 worth of time premium, that this is still a very expensive option contract, means that we're not quite going to get our maximum, even though the market is 5 points below where our short strike is. So still very good trade. We did it for 280. It's now trading for 380. We're up a dollar on the trade, less commissions. So what would we do from here? At this point, I'd just stay the course. Basically, if we can make it, we got the Fed fund, we got the Fed speaking. That makes you a little bit nervous. That would be about maybe the only reason why you might close the trade out. If you think that after the Fed meeting, we're going to get a run up in the marketplace. So I might just close this trade because I'm worried about what may happen to the markets. Now, remember, we're bearish, but I'm worried that the Fed meeting might actually spark the markets and give a big bump up to the upside. If that is not a big concern to mine. I would rather stay the course and try to get a little bit more time decay. We're 5 points in the money. If the market did come back to that 295 strike, and let's say I'm up 50 cents on the trade, but it's approaching the middle of my spread, I would then think to just get out and take a small profit as opposed to get that volatility that may have been created by the Fed meeting. Okay. So right now, stay the course. We'll just look at it. I'm actually going to use the September 30 expiration for the Meta trade, and then we'll be able to compare the two trades. But we're going to get bearish on Meta. We're going to basically do a rinse and repeat, and that's mainly because the QQQs, we mentioned last week that we were bearish just because of the tech stocks. So we were profitable on that trade. Well, let's find a tech stock that's in the QQQ or in the NASDAQ that we might want to lean a little bit more bearish on. News came out with Meta that they are losing some viewership, and that has actually driven the stock lower. That kind of helped bring the QQQs lower, and we're just going to kind of pile on that scenario. So straightforward, we're going to do a long put spread. Here we see it again inside the options playbook. We're going to straddle the market. We're going to go a little bit in the money, a little bit out of the money. We're going to go a little bit shorter term on this trade. We're going to go out to the end of September. So there's, I guess, a little seasonality in this, in that we want the trade to be done before the end of September, and September is proven, well, right now, you can't guarantee this, but so far September has proven that it is probably going to be in the negative once again on the calendar. So let's run to the stock chart first of all, and I'm going to show in the chart, we're going to do Meta real quick. And I'll just kind of show you that we did break to the downside in Meta. There was a little bit of support right around this area. And this following week, and I think what really drove it down was the news that they're losing some screen time to things like TikTok and some other social media platforms. So they're losing some time. You know, you got to be, if you're getting long Facebook/Meta, you know, you got to believe in the metaverse. And that's the reason why you would be buying now. We're at low valuations. They obviously still have a huge user base. There's still advertising revenue, but there is concerns, not only about regulation and the stuff and the battles that they're having with Apple and iOS. There's also the concern that Meta is becoming your parents' social media network. Okay, 1 second. All right, so here's going to be the trade. And before I get into it, if you have any questions, please put them in the chat box. This is a very interactive, well, we want to make it as interactive as possible here. That's part of the reason why we do it on YouTube. So please put them in the chat box and I'll try to address them. All right, let's get to the strategy. All right, so right now I'm showing in the Ally Invest option chains. And we see that Meta is at 147.98. We'll call it 148, just down a fraction today. It was actually up a little bit before we started the call. So now it's actually dropped off. I'm going to stay in that September 30th expiration. We'll do something very similar. Now, the difference is this is cut in half relative to the QQQ. This is a $150 stock. The Qs were a $300 stock. So the options won't be quite as expensive, and it's just totally based off of price. The more expensive the underlying, the more expensive the most at-the-money option contract is going to be. And then obviously you got to worry about volatility. And we have a lot more volatility in Meta. Instead of a 34% implied volatility around the at-the-money, right here we're looking at about a 50% implied volatility. So even more reason to do a long put spread if we want to get nervous. We're going to be buying one option, selling one option, and basically trying to offset some of our risk or our time decay risk or exposure by doing the long put spread. Okay, so the stock's at 148. We're going to make this one fairly simple because it's going to be a shorter trade. We're going to buy the 150, a couple points in the money. We're going to sell the 146, which is a couple points out of the money. Now, I'm going to pay attention once again. What is, in this instance, we have the call trading for around $4, and the put that we're selling is trading for $6. So net, we're selling more time premium than we're buying. And I don't mind that on this trade because it's such a short-term trade. That means that we have positive exposure to time decay. We're still going to be trading right around $2. And it's mainly, and I mentioned this on last week's show, when you straddle, when you're buying about as much time premium as you're selling, which in this instance is a little bit wider, we're selling a little bit more time premium than we're buying. But when you do that and you straddle where the stock is at, normally it's going to be about a 50-50 bet. And in this instance, it's a little better than that. You know, you're paying 193 on the midpoint, which I'm highlighting at the bottom of the screen. And you have 4 points wide. You're going from 150 to 146. So you're basically trying to pay close to $2 to make $2. If you lose 190. If you win 210. If you're correct on your forecast, I should say. Better way to say it. All right, so we're going to make this the official paper trade, and I'm going to put it over here on the right rail. And don't forget to put your questions in the chat box. We're buying to open the September 30th 150 put. At the same time, selling to open the September 30th 146 put. We'll do this, 195, it bumped up a little bit. I'm okay with that. 195, we'll make it simple. That will be our limit that we're going to put in. That's the midpoint, never a guarantee of a midpoint fill. So our total risk will be $195 plus commissions on a 1-by-1 spread. So we're sending this to the floor all as a package, hoping that the markets line up and we can fill it close to $1.95 or $195 plus commission. Our upside at 195 would be $2.05 on that trade. And then as you're putting in the questions in the chat box, I'm going to scroll down to the bottom of the screen and we'll look at the profit and loss calculator real quick like here. I'm going to zoom in a little bit and just kind of highlight the fact that, and I always go the wrong way for some reason, I don't know why, but I'm going to highlight the fact that as of today, you're going to see that this is a much flatter line. In our profit and loss graph, we're using current market conditions. We're using implied volatility, days to expiration, and come up with a theoretical, and I'm going to emphasize theoretical, prices as if the market goes up or the market goes down as of today, and the dotted line is at expiration. So you see a very flat line today, and that mainly because implied volatilities are right around 50%. Because implied volatility is so high, we need that one option contract right down at the 146 level to decay. We need that right now is trading at $4. In order for us to receive the maximum on that trade, we need that to trade. Well, it can trade for higher prices, but right now that $4 is all time value, and we need that time value to go to zero in order for this trade to max out. And that obviously usually happens closer to the expiration date. And we also need to be correct on our forecast. Okay. So 10 days, each day that passes, time decay is going to be a big player in this 146 option contract. And interesting enough, we have the QQQ long put spread, and we have now the Meta long put spread. And we'll come back next week and, we'll just take a peek at both of them. Maybe we'll get a quote on each of them. And to me, this is a very, very rinse and repeat. Obviously, last week on the Qs, the direction was right, and it's usually easy to discuss a trade when you're correct on direction. I have a profit, I should just get out. So if the market does come back, there is an adjustment that we can make to the trade. If the market comes back up and hurts these trades, there is still an adjustment that we can make, and we'll look at that. And by the way, next week we're going to be doing the show on Tuesday, but it's not going to be a live event. It's going to be a taped event, and we'll be putting that out on Tuesday. And then we're going to take a little break for a week or two on the stock play of the day, but we'll let you know more about that next Tuesday. All right. So questions. Let's see where we're at. All right, we got a few of them. Good afternoon. Hello. Hi, Dev. With 10 days to expiration from Scotty B. Once you are in the trade, how do you manage it? Do you set up exit points right now or keep looking at it and then make a decision? Scotty, with option trading, it's always better, in my mind, to have a plan before you go in. Okay, so, and I like to try to stick to the plan. When I'm straddling the market like we are, where I have $2 of risk and $2 of upside on the trade, many people will just let that ride and say, I'm willing to risk $200 on my 1-by-1 spread, and I'm hoping, well, I would be $1.95 or $195, and thinking that if I'm correct, I'm going to make $205. If I'm wrong, I'm going to lose $195. And that's an okay way to approach it if that works for you. If you want to be a little bit more hands-on, if I pay $2 for a 5, well, this one is a 4-point wide spread. For a 4-point wide spread, if I'm down $1, if I lose 50% on that trade, well, then I'm going to get out. So in other words, I'm trying to manage my risk on the downside, but I still want to let my winners run. And that's a little bit more hands-on approach. If you wanted to adjust your trade, you could also do it that way and say that I'd need it to go down a little more, but maybe I set up my 4-point wide spread. I go a little bit more at the money on the one that I bought as opposed to just in the money. And I pay $1 on my 4-point wide spread. So these are just things to think about. And if I pay that $1, well, now I have 3 points worth of upside. I obviously would need the market to go down a little bit more, because if I start at the money 4 points away, means that I need the market to go down a little bit more. And if I do that, in that scenario, I manage my risk and just saying, I'm just going to pay $1. That's it. That's all that I want to lose on this trade. So I really appreciate your questions, because this is what I think about when I'm setting up these trades. And this is what the stock play of the day is all about. I'm trying to use there's over 40 different strategies in the options playbook. And I'm looking at scenarios where the strategy matches the market conditions. Meta's very volatile, has high implied volatility. Marketplace is a little crazy. I wouldn't consider buying a put outright in Meta just because they're too expensive. If I knew the market was definitely going to go down 10 or 12 points, yeah, I would do that. But I'd much rather try to take the time decay factor out, and hence the reason why we're looking at a long call spread. And then, how do you want to manage your risk? If you're more hands-on, I pay that $2. I don't want it to go, I don't need it to move that much to the downside. And then I'm going to be in the money with both of my option contracts on my spread, best case scenario. So I can do that, pay the $2. If I'm down 50%, sell it and get out. Or I could just start with setting up my spread so I pay $1, and that's going to be my maximum risk, and I'm just going to let it ride. Two totally different ways to do it, and based off of market conditions, I've done it both ways. If I'm trading a long spread, and let's say I was bullish around earnings, I would do the latter. I would do where I'm going to set it up where my maximum risk is what I really am willing to risk. In this scenario, we're just doing it because the market's bearish and we're in September. It's that simple. All right. Oh, appreciate that, Scotty. All right. Any other questions? I look and we are almost at the half hour here. It's noon 30 here in Charlotte, North Carolina. Last chance for questions. I appreciate that, Dev. I appreciate the comments. And yeah, share this with your friends. Let people know about it. We want to this is free for all. You don't have to be an Ally Invest client. We just want to learn here on the stock play of the day. Nothing's meant to be a recommendation. I always need to emphasize that. We don't know what your situation is. Just think about if you're trading a particular underlying, one of the things to take away from this is that underlying might fit this strategy, whereas, we got bearish on the SPX before, and we did it with a butterfly, as opposed to doing a bear put spread. If you want to go back and look at that scenario, and it's mainly because we were in the SPX, and the SPX is a very expensive underlying. So we decided that we would do a butterfly, and that allowed us to get bearish, but greatly reduced the cost relative to just a flat-out long put spread in the SPX when we got bearish in the SPX, not that long ago. Everything's archived. We've got a huge watch list. Share it with your friends. Let everybody know. And that's going to be it for this episode of the Stock Play of the Day. Thanks for participating in the chat box, and we will see you this Tuesday for the next Stock Play of the Day. Click subscribe, ring the bell.